Hey, what's going on, PCP students? In this video, we're going to talk about stock splits, reverse stock splits, why they could be potentially good or bad for the company you chose to invest in. So all that and more coming right up. So let's talk about stock splits first. Stock splits can be super beneficial to people who are investors in companies. Tesla and Apple just came out with a stock split about a few months ago, and their stock price skyrocketed. So what happens? When a company decides to do a stock split, they increase the number of shares outstanding and lower the individual value of each share. This does not mean they're diluting the stock. Many people confuse stock splits for dilution. They are not diluting stock at all. You're going to have the same exact equity when the stock split takes place. So, for example, if you have one share of Tesla worth $1,000 pre-split, your equity in Tesla is $1,000. If they do a 5-to-1 split, which they can choose whatever ratio they want, but generally 5-to-1 is the most common. After the stock split, you'll have 5 shares of Tesla, now worth $200 a share. If you do the math, that's still $1,000 of equity. Why do companies do this? As you can see here from the pros, it lowers the share price to become more affordable to new investors. This is great because not many people want to just buy one share of a company for $1,000 if they only have $1,000 in their brokerage account. And this is a super good way for beginner investors to actually invest in the company. I know, I think Robinhood does partial shares and fractional shares, but this way you can actually buy full shares. And as you can tell, with more buying pressure generally comes an increase in stock price. When Tesla announced they were going through a split, I believe it was right in this area. Leading up to split, it shot way up in the actual day after split. It had a huge surge of momentum, but look what happened. The very next day, it sold off for a few days because it quickly became overbought as it went from $300 a share all the way up to $500 a share. I was an investor in this. How do we actually trade these? Now, what I personally do is when a company comes out with a stock split, I buy shares leading up to the split. The day after the split is generally when I sell, as I do think stocks can become very overbought after this because there's a lot of buying pressure like I talked about. And you can see at a pretty nasty sell-off from $525 all the way down to $300 even. And obviously it's recovered much higher since then. But that's usually what happens. Stocks have huge surges of momentum, holds it for a few days, and afterwards comes down and kind of corrects itself and then eventually pans out. I hope you can now see why this is beneficial so beginner investors can actually take part in investing in companies they believe in. Apple did the same thing, but Apple's done multiple stock splits. The last time I invested this is when the news came out. This was the day after the split, and then right after it had a very heavy sell-off from all the way to $140 almost, all the way back to almost $100 a share. So you do not want to hold much after split if the stock starts to decline and come back to reality, as it can become very overbought over the next few weeks leading up to the split. Stock splits are very simple, and if you see this is generally a really good sign for the company. And I, from experience, have seen the actual share price go quite a bit up leading up to the initial stock split. Now on to reverse stock splits. This type of stock split is generally not good or encouraged when trading or investing in a company. If you see this, generally it means the company is in distress, as said in the definition, and this is not really good for investors. So in the example, if you have 1,000 shares of KTLV, this is one I remember trading, worth $1 pre-split, it's worth $1,000. After that 1 to 10 split, you'll now have 100 shares of KTLV at $10 a share, still worth the same amount of equity, but soon after you're going to see generally it is a big sell-off. Cons: increases the price generally to meet compliance, so stocks do not get delisted. That's what I've found. In the definition, it says fewer proportionally more valuable shares, reducing the total number of outstanding shares in the open market that can be sued for a number of reasons, and often signals company is in distress. That is obviously not good if you are investing into this company. So let's look at some examples. If we were to look at the one we talked about, KTLV, this is what happened after a split. It was doing pretty good, riding that 90 EMA line. I actually was an investor into the stock, and then boom, they came out with stock split news, and this thing tanked from what was about 86 cents around the $1 mark all the way down to 30 cents a share. And then when the actual stock split came out, it was at $3 a share. So this is not good for investors. As you can see, that's some damage right there. If you were to just take the trend line tool on this example, you would be down over 50% of your overall position. That is not good. So now you see why it's important to know what stock splits and reverse stock splits are, how you can take advantage and trade them, and what to expect in the near future if a given stock that you're invested in goes through a split. So I hope that answered all of your guys' questions about splits. If you have any questions about stock splits or reverse stock splits, don't hesitate to DM me, as I'm always there for you guys to answer any questions as best as possible. But if you think you got the hang of it, click save and continue. I'll see you guys in the very next video.